Seeing this weakness now?
Well, this week we saw interest rate rises out of the Eurozone by the ECB, and then also we saw a major sell-off on Thursday in the U.S. bond market, which then kind of caused concern that inflation would potentially hit the market and also gave a little bit more attractiveness to bonds rather than equities, at the latter end of this week.
And of course, more fears of another interest rate rise, certainly not ruled out by any means by the ECB.
No, exactly. And not only just the ECB, the Monetary Policy Committee in the UK, the Bank of England, has also signaled that they'll probably have to raise rates. So we are in this kind of global rate tightening situation, which I think puts, equities at a little bit of a dangerous spot right now.
And is inflation a real problem on the horizon for Europe?
Well, it doesn't seem like there's really bad inflationary measures going forward. The data seems to be relatively benign, and oil, although approaching $70 a barrel, doesn't seem to be really impacting prices so much. But yet the ECB and both the UK and the Bank of England are concerned about rising prices, and therefore they're raising rates.
And what about Ben Bernanke at the Fed?
Gave a really mixed signal to the markets this week. I think people were originally expecting that the U.S. could cut rates in 2007, and that has now been dramatically changed to now rates are probably going to be on hold through 2007 and maybe into 2008, which has really caused a dramatic shift in market sentiment this week.
Why is that?
I think, the unemployment numbers have not been as weak as people expected. The housing deterioration has not affected employment. Productivity is still looking pretty good. So the data has not been uniformly weak for the Fed to cut.
If it wasn't for the weakness in the housing market, perhaps the pressure to raise rates in America would be quite a lot higher. That's a bit of wiggle room, I guess, Ben Bernanke.
Well, yeah, that's a very interesting point you mentioned today, because we've had some activity in the market that people were now talking that maybe the Fed could be on the verge of absolutely raising rates. So this kind of market volatility, it shows that people really don't know. And they're going to be looking at every data point to get a little bit more color as to what the Fed's going to do going forward.
Now, you mentioned the bond market. That's going to be another problem for stocks, isn't it? It's got to start reflecting what's going on in the bond market, what's happening actually in the stock markets.
Well, I think that what you saw this week was the bond market paid a lot of catch-up. The equities have been on a strong run for a long period of time, specifically in the U.S., and now we really saw a sell-off in the bond market reflecting kind of the growth aspects that the stocks had been benefiting. So I think what may happen is that you'll probably see the bond market take a pause right now, kind of see how much damage has been done, and whether or not rates are going to go up even further, or whether they're just going to stay where they are, and then the markets will adjust at this new level.
Outlook for the next, 4 weeks. Look into your crystal ball.
Well, I think what you're going to see is, these higher levels of interest rates are going to stay. I think, overall, it might be better for stocks because if the growth picture around the world is still intact, then that is generally good for stocks. And I think if you look at the inflationary numbers and they're relatively calm, I think that would cause the markets overall to be relatively benign. So I think you kind of have a grind higher, but I don't think you have massive jumps. But the bull trend probably continues, but with a little bit of these setbacks with the data if it surprises to the downside.